All right, everybody, come on in, make yourself comfortable. We'll get started in about 60 seconds. All right, everybody, we're going to get started in about 30 seconds. So come on in, make yourself comfortable, and we'll kick things off. All right, well, welcome to your July webinar on lending changes that may impact you and the property market. My name is Jeff Thurecht. I'm a director at Evalesco, and I'll be your host today. I'm really excited to be joined by my talented and helpful colleague, Kristi Teasel. Welcome, Kristi.
Thanks, Jeff.
While it's Kristi's first time on the webinar, Kristi will definitely be very familiar to many of you, having been part of the Evalesco team for about 14 years. Kristi's role for the last 5 years or so has been in supporting our clients with their lending needs, and she's now leading our mortgage broking team. So Kristi brings a wealth of knowledge and understanding of the practical implications of lending strategy and implementation, and I'm sure you'll find her thoughts to be very, very helpful. Before we get into today's conversation, I'd just like to let you know that you at home are on mute during the webinar and we can't see you. Your video is off, so please feel free to chat amongst yourselves and move around. We would love, however, to get your questions. So down the bottom of your screen, you'll see a Q&A box. So tick that and type in any questions that you may have. I'll check those as we go through, and we'll either answer them as part of the conversation, or we'll come back to them at the end if we have time permitting. If we can't answer those questions, we'll get the information for you and come back to you later. Most of the information and conversation today will be about general investment markets and lending concepts with some specific examples. So I'm going to just provide a general advice disclaimer, which says that even though most people on this webinar are clients of Evalesco, as we go through this conversation, we're not considering your personal circumstances, so you shouldn't regard anything that we say today as personal advice. If you would like to know more about how this might impact you personally, then please get in touch with your advisor, with me or with Kristi, and we'd be happy to go through that with you in a bit more detail. So today's agenda, I'm going to run through a bit of an update on the current housing market. Then we're going to hand over to Kristi to talk about what is a serviceability buffer, how recent rule changes might affect you, which banks are working with us in regards to their serviceability buffers, and finish off with how to prepare for your fixed rate home loan expiry if that is the case. So before we launch into that, I'm just going to raise a poll which will give us the opportunity to find out how relevant, I guess, the fixed rate question and topic will be. So up on your screen, I'm just launching now. A question: is your home loan fixed rate expiring in 2023? It is something that's been getting a lot of press about the fixed rate cliff, and it's quite topical and affecting a lot of people. So just interested to know how many people on our call today are in that boat. So about a third of the people, it looks like, having a fixed rate expiring in 2023. So that's great. Good to know. We've got some information that we can talk about towards the end of the presentation, which might be helpful. Others, maybe your fixed rate's expiring next year and you might need to know this as well, or you haven't got one, which you can take it as interesting information as opposed to practical. I'll end that poll. So kicking off on the current housing market. So on this slide here, we're looking at some stats on the Sydney housing market up until the end of May on this slide. You can see the last couple of, sorry, this is up to the end of June. You can see the last couple of months have seen an uptick in Sydney home values, somewhat surprisingly to me and many pundits. This has primarily been driven in Sydney by the higher end of the Sydney housing market. These stats are from CoreLogic, and they determine the higher end of the Sydney market has contributed about up about 5.7% for the 3 months till the end of June, which is quite a significant rise. You can see there overall for the last, from the peak, which is in January last year, the Sydney market is still down around about 9.6% from that peak, but starting to recover. We all know that Sydney isn't one property market. It's made up of many individual markets which do behave differently. There's apartments as well as homes, as well as the different regions in Sydney as well. Some of the outer suburbs of Sydney are starting to show some more evidence of succumbing to the pressure of rising mortgage repayments through an increase in distressed property sales. So these distressed sales, while still reasonably low, have started to increase significantly and tripled in areas such as Bringelly and Green Valley, and doubled in the Penrith and Camden regions. So it's those types of, I guess, signals that are interesting and starting to potentially be impacted by the rising interest rates that we've seen, and we're going to talk more about. If we look at the overall Australian market, we can see it's a reasonably similar shape to the Sydney market, with a little bit of an uptick in recent times. It's down around about 5.3% in the last 12 months overall. There was some gains in regional South Australia, while the biggest decline was in Hobart, with about a 12.7% decline over the 12 months, which is pretty significant. There's some of the interesting stats starting to come out as we sort of drill in a little bit here further. Is that CoreLogic estimates that a relatively high proportion of new listings added in the last couple of months have been investment properties. So they were up to about 32%, close to 33% last month, compared to long-term average of about 25%. So this may be expected as the cost of living starts to, and interest rates start to bite. So people will hang on to their home and make sure they can continue to pay their own personal mortgage. But if things are getting a bit tight, then potentially they start to look to sell investment properties. And this could continue to place downward pressure on prices if it continues, as supply will increase and people may be looking to get out more quickly. So that's just one part of it. Thanks for the questions coming in. That's great. So keep those coming and we'll come back to those as we work through. On the next chart, we've got a chart around rental yields. So there's lots of talk in recent times about increases in rents. Rental yields declined slightly in the last couple of months, but that was mainly driven through the increase in capital values. So the capital growth on properties over the last couple of months has outstripped the growth in rents. So that's a little bit of a deceptive slide, I suppose. In real terms, Australian rents increased by a further 0.7% in June, and taking an increase nationally to just under 10%, 9.7% over the last 12 months, which is pretty significant. And, significantly more than the long-term average, which is usually about 3% a year of growth. Potentially, there are some signs that rate of rental growth is slowing a little bit, having peaked at just over 10% in the last calendar year. So it's certainly one to watch as well. This slide is probably not new to anyone here. This is about the mortgage rates that have increased. And you can see it's pretty confronting with the very steep gradient at the right-hand side of that graph, where interest rates have increased significantly. This was after the last interest rate rise in June. The RBA did pause the increases for July. And yesterday's inflation figures, for those of you who saw that, came in lower than expected, which gives some confidence that there may be another pause in interest rates, or not as much of a hurry. Having said that, excuse me, I've seen a few commentators today talking about, digging into the components of that inflation figures and saying there's still some reason to suggest that there's a bit more work to be done to curtail inflation overall. So the RBA will be meeting next Tuesday, and we'll see what the decision for August is. So that's a bit of an overview of the property market. The question that came through was in relation to the impact of returning migrants to major cities such as Sydney and Melbourne particularly, and how that might impact the property market. I think it's a good question. I think it's certainly having an impact on the rental market and contributing to the rental increases, which we just touched on that previous slide. It'll be interesting to see how it does play out in terms of the supply and demand equation, given there has been a little bit of underdevelopment, and we're seeing now some challenges with some of the developers building new stock, more collapses of those developers and builders this week. So I think it's likely that will have an impact. It's just whether that outweighs some of the other factors which are sort of holding prices down. So without having a crystal ball, I think it's certainly something to consider. So I'm going to hand over to Kristi, and I guess the background of some of the things we're talking about now is really the Banking Royal Commission highlighted some practices which APRA were concerned about from lenders, as tends to be the case, and that may have led to a bit of an overcorrection in some of the changes to regulations. And that's been in some ways, I guess, exacerbated by the increases in rates in recent times.
Yeah.
So, some of those changes were really around serviceability calculations, which is about how much banks will actually lend.
Yes.
So what we're going to go through now, and I'll hand over to Kristi, is some of those changes and how that's impacted, and some good news in recent times as well.
Okay, so what is a serviceability buffer and how will these recent changes affect you? I might get you to go to the next slide, Jeff. So the buffer assesses your ability to service a home loan at 3% higher than what the current rates are on offer. For an example, if you are applying for a home loan which has an interest rate of 6.04%, this will be assessed on your ability to repay at the same loan at 9.04%, which is a big difference. This buffer does exist to minimise financial risk in the lending sector. If you could only service your loan with an interest rates were low, this does cause risk of defaults once inflation does push up interest rates, and this is why this buffer does exist. We have found that many of our clients who have bought or refinanced in the last few years are not in the position to refinance or borrow any more money given the increases to interest rates. And this is resulting in reductions to everyone's borrowing capacity. This is what is commonly referred to as a mortgage prison, which has left many of you being stuck or trapped with your current lender, who might not be offering the most competitive interest rates.
And that's where, because the rates have risen so quickly, this buffer has stayed the same. And so people were previously being assessed on rates at 4 or 5% from a buffer viewpoint, now being assessed on twice as high,
much,
in some cases. So what that means is where they previously could service a loan, to get a new loan is much more challenging.
Yes.
So they can continue to pay, hopefully, on the existing rate, but it's difficult to have that competition to be able to go out and negotiate a better deal, which was a normal function of the market.
Of the market, yeah.
Yeah.
And I guess we've got an example here of if you were a borrower to apply and secure a loan a few years ago, when rates were a lot lower, a lender might have looked at your ability to repay at 5.50%. So this allows you to borrow $700,000. Today, because of the number of rate rises we have experienced, lenders will be assessing your ability to repay at figures closer to 9%. So you might only be able to borrow $500,000. The nation's banking regulator, APRA, has suggested adjusting this affordability buffers in order to help many Australians who are trapped in a mortgage prison. Some of the major banks in Australia have taken steps towards easing the burden by lowering their serviceability buffers. This means that if you meet the criteria, you could benefit from the serviceability buffers. For borrowers who meet the criteria, this can provide a way to avoid ending up in a mortgage prison.
So we're going to go through some of the criteria on the next slide.
Yes.
So I guess there's another factor at play here that we're seeing as well is it's not just about refinancing, it's people are looking to buy a new home or make a new purchase. Previously may have been able to borrow, as per this example, $700,000 to buy that new home. Now,
they can get
the property market might have gone up over the last couple of years, as we've seen, particularly over the last 12 months, but borrowing capacity's gone down. So it makes it harder for some people who are, a little bit tighter on that borrowing capacity to be able to buy the same property they might previously been able to buy, which is another challenge of some of these restrictions. But the main one we're seeing, I think, is really that refinance opportunity and looking at getting a better deal.
Okay, so 3 out of the major banks have announced reductions to their serviceability buffers for refinances only, with NAB becoming the third to join these banks, followed by one of the smaller lenders, Bankwest, who announced on the 14th of July that they will also be reducing their serviceability buffer. Let's have a closer look at these adjustments that the banks have made so far. So CBA is one of the first ones to drop their buffer by just 1%. NAB also will be dropping their buffer to 1%. However, they have adopted a case-by-case approach. So they will be looking at each application and will make a decision whether that is suitable for them to take on. Westpac is also a case-by-case approach in evaluating if the serviceability for refinances will lower their buffer to 1%. And Bankwest has also dropped its serviceability by 1%.
No, it's just a very recent announcement, wasn't it?
Yes, yeah.
So what are some of the, obviously you said, case by case, what are some of the conditions, or how would you look at meeting those requirements?
Yeah, so the conditions are that you have to show good repayment history for the last 12 months. They want to make sure that your current income and expenses, including current loans, are being disclosed and verified. The refinance must be dollar for dollar. You cannot borrow any more than what your home or investment loan is. Yeah. Your loan cannot have a lender's mortgage insurance or LMI. Repayments must be lower than what you're currently paying when comparing for a like-for-like with your existing loan. Repayments must be P&I. However, Bankwest is one of the lenders that will consider interest-only repayments if it's for an investment loan. They won't consider it if it's for a home loan. It's only for investment purposes.
Okay, so they're not particularly onerous requirements if you're looking for a straight refinance and you've been meeting your repayments, but there are a couple of extra steps that will be expected to be put through. And I think as we touched on, this is really, I think, in response to APRA's concern about, it was fairly anti-competitive environment, really, because it was meaning a lot of people didn't have the options, so banks could potentially have, carte blanche to put the rates in as they wanted to, not giving people a lot of flexibility, so they wanted to open that up to a bit more competition. And the bigger banks are probably in a stronger position given their flow of business and access to credit to really influence that in the short term. Just checking a question coming through there. It's a comment about, some good feedback. If you've been making additional repayments over previous times, that puts you in good stead, and the bank can see that you've got that history and track record. It gives you that buffer built into your own loan as well, but also I think that would be favourably considered in these types of circumstances, where you can show that your repayments are going to be less, or you could scale that back if you needed to do that as well. Get the questions or comments coming as well. So moving on to, as we talked about the fixed rate cliff, so a third of you here, this is particularly pertinent for what you're facing.
So fixed rates in particular were at levels that we haven't seen in decades, giving many borrowers access to abundance of options around the 2% mark and a lot lower. Many borrowers made the most of this opportunity to lock in their mortgage at the low interest rates. Since then, there has been a considerable shift in the interest rate landscape, with interest rates increasing 12 times since May of last year. The flow on this is that many homeowners who had fixed part or all of their loans during 2020 and 2021 are now in for a sharp increase with their repayments when their fixed rate expires. For an instance, repayments for an interest rate of 1.79 and 5.94 based on $100 million balance being paid over a 28-year year term will go from $3,965 to $640, which is almost triple what they're currently paying.
So that's a pretty significant increase. We had an example this week, some clients coming in looking at their cash flow. That really does bite into your cash flow when that happens. And at this case, there's, I guess, at the bank's discretion to, when your rate expires, to move you to their standard variable rate is the normal sort of process that you would go through.
Yes, yeah.
So we're going to talk a little bit more about what you can do to prepare for when that does come off, and then might dig into this a little bit further.
So I've thought of some hints or tips that you can do to prepare for when your fixed rate is expiring. So I guess the first one is rework your budget. One of the first steps we would suggest is to find out just how much your payments are likely to increase by. The possibility of more rate hikes from the RBA may throw a spanner in the works in terms of working out exactly what your interest rate will revert to. But even if a rough estimate can help when it comes to adjusting your budget and to account for the higher repayments. Look at where your money is going and see where you can cut back. Reach out to your financial advisor for some budget advice.
And that's where, to the comment that we had from the audience before, from Andrew, that people who've been paying additional repayments off their loan
have helped them
become conditioned, become conditioned to that expectation. If you've been able to save a little bit of money along the way through those additional repayments, potentially your savings capacity drops off a little bit, but maybe you can continue to meet those. So it's good to get a clear understanding of what you're going to be facing, as opposed to just being concerned about the big jump. Know what you're looking into.
And I guess another good one is to negotiate to get a better rate. If you're not happy with the interest rate that you are going to be paying once your fixed rate expires, there's no harm in trying to negotiate a better deal with your existing lender. If we are the broker for your loan, which most of you are, we can do this on your behalf and negotiate with the lender to get a better interest rate for you. Even if the rate is not what you were hoping to get, remember that every little bit of money is going to help your back pocket, even if it's 10, 15 or 20 points reduction, it all will help.
Definitely. And as we touched on before, that the bank will normally automatically revert to their standard variable rate. And not many of our clients pay the standard variable rate.
No.
So, that's the automatic option. So even if you are, dealing directly with the bank, it makes sense to contact them and say, what's the best rate you can do for me, and negotiate on that. Probably not, usually you can't negotiate on fixed rates. And what we're seeing at the moment is fixed rates are higher than variable rates anyway, in most cases.
Yeah, most cases they are.
Sort of forecasting some potential further increases. So I don't think in most cases we would suggest that people look at locking in fixed rates at this
point. Not at this point in time, no. Another option would be to consider an offset account. Whilst offset accounts are not commonly available when your home loan is fixed, however, if you're going to be moving into a variable home loan, once your fixed rate expires, an offset account can be a really valuable transaction account that is worth looking into if you don't already have one. It is linked to your standard variable rate home or investment loan, and the money you put into this offset account reduces the balance on which the bank charges interest. This means you will only be paying interest on the difference. An example of this would be if you have 50,000 in your offset and your loan balance is 300,000, you will only pay interest on 250,000 of your loan balance.
So it's a powerful tool, and to Kristi's point on the previous point, doesn't matter how much you've got. If you've got a little bit of money in the offset account, it just means that you're going to pay off more principal more quickly on a regular basis. And if you are able to save a little bit, it gives you that chance to have a cash buffer.
Yeah.
We like to encourage our clients to have that cash buffer there, that rainy day sort of money. So that's a great place for an offset account to go. Doesn't necessarily reduce your repayments at that point in time, but it means that your repayments are paying more principal and working harder for you. So it's a good strategy to consider.
Think about refinancing. Whilst the current market is making it harder to refinance to a different lender, there is no harm in checking with us to see if you're able to refinance, or you might be eligible for that 1% buffer that some of the lenders are offering.
And this is an attractive option when you've got good equity in your property. So the serviceability is one part of it, which we've touched on in the previous few slides. But if you've got some equity in your property, which if you've owned the property for 4 years or more, there's been some good periods of capital growth over that time. As we touched on, prices may be off in the last sort of 12 or 18 months. But if you've got a strong equity position, that gives you a good chance to negotiate as well with the lenders, as well as looking at the serviceability side of things.
And I guess the last point is reach out if you need help. Given the size of the jump in repayments that many borrowers will be facing, and also taking into account the other cost of living pressures, everyone would be starting to feel the pinch. So please reach out to your advisor or myself, and we can see what we can do to help you through this period.
Yeah, certainly from a practical viewpoint, we've seen an uptick in people having conversations around these types of challenges with cash flow, cost of living, biting across the range of expenses. So it's really becoming a much more consistent conversation. It was all nice when rates were at 2%, but it is the reality now that things are getting tougher. So I think we're here to help have those conversations. We can negotiate on your behalf with the lenders. We can talk about how you can manage your cash flow, restructuring things, and often find there are some pretty quick wins out of some of the things we're able to do. Or give you some ammunition to go back to your bank and push a little bit back on them as well. So definitely reach out if you're starting to feel the pinch or coming up against a fixed rate home loan expiring later this year. So that's the end of our formal presentation. We'd love to have some questions if there's any other questions. If there's any feedback in terms of this is the first time we've done a late afternoon webinar. So any feedback on the timing as opposed to lunchtime? Some good feedback there. Thanks, Matt, for Kristi. So yeah, if there's any feedback in terms of the timing, trying late afternoon instead of lunchtime, we'd love to hear about that. Any other topics you'd like us to cover off or any further questions, then please get in touch with your advisor or Kristi and I, and we can help with that. So I'll give another 20 seconds for questions, but if there's nothing coming through. Thanks, Kristi, for your insights.
You're welcome.
Okay, what Matt's comment there? Great debut. Okay, there we go. We've got a couple of responses. Some people prefer lunchtime, some people prefer now. So that's good feedback. We can continue to alternate potentially. And also, the recording will always be available. Anyone who's registered will get an email of the recording, and it's available on our website usually in the days following the webinar as well. So check out there if the timing doesn't work for you when we're holding these. But thank you very much for your attendance and the questions and the feedback from everybody at home. We'll sign off now and wish you a good evening. Thanks. Bye.